You're probably not paying much attention to the debt market right now. But what if I told you that it holds more power over the global economy than stocks, crypto, or even central banks? And what if I also told you it's starting to crack? By the end of this video, you'll understand exactly why some of the smartest investors in the world are preparing for a debt market shock. One that could trigger a global recession, collapse major institutions, and reshape everything from interest rates to your job. Let's break it down before it breaks everything else. In this video, we're going to dig deep into why the global debt market, the market for government bonds, corporate debt, and sovereign risk, is dangerously unstable. We'll look at what signs are flashing red, who's most exposed, and what could happen if it breaks. And most importantly, you'll learn how to protect your wealth if a full-blown debt crisis erupts. First, let's be clear. The global debt market is absolutely massive. We're talking over $300 trillion in total debt, more than triple the size of the global equity market. This includes government bonds, mortgages, student loans, corporate bonds, you name it. But unlike stocks, the debt market is considered safe. Treasuries are called risk-free. Corporate bonds are investment grade. And everyone assumes the government can always pay. But that assumption is breaking. What's happening now is a quiet storm building behind the scenes. Yields are rising. Bond prices are falling. And countries, especially in the West, are facing interest payments they can barely afford. The US alone now pays nearly $1 trillion a year just to service its debt. That's more than it spends on defense. And it's growing fast. This creates a dangerous feedback loop. To pay for the interest, governments issue more debt. More debt means more supply. More supply pushes prices down, yields up, and the cycle tightens. Now here's the part nobody talks about. When bond prices fall, the financial system starts bleeding. Pension funds lose value. Banks holding long-term bonds suffer huge paper losses. Insurance companies get squeezed. And central banks, like especially in Europe and Japan, find themselves trapped. They can't raise rates without blowing up their own balance sheets. If this sounds familiar, it should. This exact problem triggered the collapse of Silicon Valley Bank in 2023. They had safe US treasuries until rising yields wiped out their capital base. Now imagine that same problem across the entire global financial system. And it's not just about the US. In Europe, countries like Italy and France are running debt levels above 110% of GDP. Japan, over 250%. Even China, which used to be seen as the lender to the world, now holds massive internal debt through local governments and state-owned firms. According to the IMF, over 60 countries today are either in debt distress or at high risk of entering it. This is not sustainable. And in markets, when something can't go on forever, it eventually stops. Big investors know this. Ray Dalio has warned that we're entering a new phase of the long-term debt cycle, a phase where old solutions like cutting rates or printing money stop working. That's why hedge funds, sovereign wealth funds, and even some central banks are moving away from bonds. They're reallocating into hard assets, gold, real estate, commodities, and even preparing for a currency realignment. Because if the debt market breaks and confidence in repayment disappears, the entire system gets repriced, and not gently. We've seen this before. In 1998, Russia defaulted on its bonds and triggered a global panic. In 2010, Greece nearly took down the Eurozone. In 2022, the UK bond market almost imploded, forcing the Bank of England to intervene within hours to save pensions. Each time the trigger seemed contained until it wasn't. This time the scale is global, and the dominoes are bigger. Let's talk about what happens if the cracks in the debt market turn into a full-blown break. It won't start with a headline like "Global Crisis Begins." It'll start quietly. A failed bond auction in a mid-sized country. A surprise downgrade. A sudden spike in yields in one corner of the world that nobody was paying attention to. And then liquidity dries up. When bondholders panic, they don't sell slowly, they rush for the exits. That creates a spiral. Prices collapse, yields spike, and institutions that were holding bonds as safe assets are suddenly looking at billions in unrealized losses. Banks, pension funds, insurers, all marked by the same vulnerability. Just like what happened to Silicon Valley Bank, but on a much larger scale. Now picture central banks caught in the middle. If they raise rates to fight inflation, they worsen the debt crisis. If they cut rates or print more money to save the system, They risk triggering another wave of inflation or destroying their currency's credibility. That's the trap, and we're already in it. The first fault line to watch? The United States. The U.S. Treasury market is the bedrock of the global financial system. If investors begin to seriously doubt Washington's ability, or willingness, to manage its debt responsibly, it could trigger a loss of confidence in the dollar itself. And remember, over 60% of global central bank reserves are still held in dollars. If trust is lost there, we're not talking about a correction. We're talking about a global monetary reset. The second fault line is Europe. Italy's debt is now above 140% of GDP. France has already been warned by rating agencies, and the ECB is in a difficult position. It must support these countries while also trying to control inflation. That tension is unsustainable. One more rate hike, one more political misstep, and you could see a sovereign debt event like Greece in 2010. But much bigger and with systemic consequences. The third weak spot is China. Everyone talks about China's foreign reserves and economic power. But underneath, many of its local governments and state-owned enterprises are drowning in off-balance sheet debt. The property crisis was just the first domino. If Beijing is forced to admit the scale of its debt problem, or worse, if capital starts fleeing in large volumes, it could spark a wave of devaluation and panic across emerging markets tied to Chinese demand. So, what does this mean for you? It means that traditional safe assets may not be so safe anymore. It means you need to think in terms of liquidity, counterparty risk, and diversification across uncorrelated assets. Smart money is already doing this. They're moving into short-duration bonds, gold, commodity-linked investments, inflation-protected assets, and even holding larger cash reserves. Not because they're scared, but because they're waiting to act when everyone else is forced to sell. This is how wealth is preserved and built during a crisis. Warren Buffett once said, "Only when the tide goes out do you discover who's been swimming naked." When the debt tide turns, most investors will realize too late that they were exposed. But not you, because now you know what's coming. So we covered why the global debt market is cracking, how it could impact economies everywhere, and what investors are doing to prepare. If you want to understand how to protect your wealth in this new world, or even grow it while others panic, hit that like button, subscribe to the channel, and turn on notifications. And let me know in the comments if you'd like a full video on where the smart money is moving right now. Because if a global debt shock is coming, you want to be ready before the headlines hit. The sooner you prepare, the stronger you come out on the other side.